The Bank of Canada hiked the key interest rate today for the first time in 7 years. The rate going up by 1/4 percentage point from 0.5 to 0.75. And joining me now to explain what this all means for Canadians' wallets is personal finance expert Preet Banerjee. Thanks so much for coming in.
My pleasure.
So let's start with the obvious concern for some homeowners who are, they've got mortgages, they need to pay them down. So what's the impact going to be to those trying to pay down their mortgages?
Well, a lot of people actually won't feel it right away. So if you've got a fixed rate mortgage, what you signed up for was that your payment wouldn't change for the term of your mortgage. So until that ends, you're not going to feel an impact. The fear is when you renew that, is that going to be in a much higher interest rate environment? And I'd actually say there are some current fixed mortgage rate holders who will actually renew into a lower or similar rate that they have right now, because interest rates were falling for fixed rate mortgages for a while. Now, if you have a variable rate mortgage, a lot of people say, well, I know that that's tied to interest rates, so will that impact me? Yes and no. So a lot of variable rate mortgages are actually set so that the payment does not change, but the portion of your payment that goes to paying interest will increase, meaning that what's left over paying down the balance will decrease.
So you may not see it, but it's there.
It makes your mortgage longer.
Right, yeah. And there's a big discussion about whether you lock in.
Right.
Do you get a fixed? Do you get a variable? If you're looking to buy a home right now, what do you do? Do you do variable? Do you do locked in?
Yeah, so there's a lot of analyses out there, and it really revolves around how clear your crystal ball is. So if you can predict rates perfectly, I'll tell you what to do. So what I would say for most people, it comes down to their cash flow and their security of their cash flow. So if you go fixed, you've got the predictability of knowing that your payments aren't going to change. So if you're a first-time home buyer, a lot of people like that predictability. If you have a lot of a buffer with your cash flow, then a lot of people are more likely to sort of roll the dice and say, I'll get the lower rate on the variable, and if it goes up, I can stomach it. So that's kind of, the calculus that a lot of first-time home buyers sort of think through. So if you want predictability, they tend to go fixed.
You talked about cash flow, and that's great for homeowners, but when you're a student and you don't have that cash flow, and now you're thinking about student loans and how this could impact student loans.
Yeah, so when you graduate and you're saddled with that big student debt, you have the choice. Do you want to go with a fixed rate or do you want to go with a variable rate? So if you went with fixed, you're not going to see any change in payments, but if you went variable, you will see your payments start to rise a little bit.
Yeah, so do you need to start planning?
Yes.
Because you need to start planning.
Yeah, so this is sort of, a lot of people, let's put this into context. This is not a cataclysmic change that's going to change the way people look at debt overnight. This is a one rate hike after we had 2 cuts that a lot of people weren't expecting back in 2015. So there's not a huge impact, but it might be a good wake-up call for a lot of people, because now this sort of does portend an era where interest rates will start to slowly go up over time. And so you need to think about what is going to give, because if the cost of servicing debt is going up, something else has to give. So what are those trade-offs you're willing to make, and you need to think about them before your hand is forced.
So what you said there was that over time you're expecting them to go up, and you're expecting interest rates to increase. I mean, a lot of analysts are saying that it's probably not the first rate hike this year.
That's the consensus. So short term, they're basically saying, they're kind of rolling back those 2 rate cuts from 2015, which was a result of the oil shock. And the governor of the Bank of Canada said a month ago, those cuts did their job, not are doing their job, did their job, implying that they're no longer needed. So if that's the case, then a lot of people are saying that means there's one more rate hike on the way, potentially this year. Then there might be a pause. And if the economy is doing well and it's not, adversely affected by this, then that gives them the opportunity to raise rates down the road. So it's not going to happen fast if it does happen. And we don't really know, but that's sort of the consensus view right now.
There were probably a lot of people that went on buying sprees, right? Yes. Because lines of credits were almost zero. And so now, how do people need to shift their mindset or shift their focuses?
Great question. If you look at younger Canadians, this is not the new normal for them, where you have a lot of debt and low interest rates. That's the only normal they've ever known.
That's right.
Right? So for them, a lot of eyes are going to be, well, how are they going to react with possibly a progressively rising interest rate when they're used to big student debts, massive mortgages to afford house prices, and auto loans that have been getting longer and longer? Debt is just the way of life for them. So the cost of servicing all that debt is high, and if it starts to creep up, it can really pinch their lifestyle. So we're really interested to see how that works from a behavioral point of view, for sure.
Very interesting. Thank you for joining us, Preet.
My pleasure.